and thank you for joining our 2023 Fraud and Financial Crime webinar. My name is Raksha, and on behalf of Kroll's marketing team, I'd like to welcome you and walk you through some of the features of our presentation today. On your screen, you should see a Q&A box currently highlighted. We invite you to submit your questions using this feature. You can also use the Q&A box to share any technical difficulties or any other questions to our producers. Also on your screen is a speaker bio section. You can learn more about our speakers and find details to contact them directly in the section. You can download our Fraud and Financial Crime Report directly from your screen today via the Take Action button, which is now highlighted on your screen. Finally, we encourage you to send emojis and reactions to our speakers throughout their presentation today, and you can do that via the Reactions button on the menu at the bottom of your screen. We hope you enjoy our presentation today, and I will now pass it on to our moderator, Mary-Ellen Davis-DeMarco.
Thank you, Raksha. Hello, and welcome to Kroll's 2023 Fraud and Financial Crime webinar. I am Mary-Ellen Davies-DeMarco, a Managing Director of our Compliance, Risk, and Diligence practice, and I will be the moderator for this discussion. I am very excited to be speaking to this panel today, considering the vast experience that they all have in their respective fields. So it is a true pleasure for me to introduce David Lewis. David is a Managing Director and Global Head of Anti-Money Laundering Advisory. Prior to joining Kroll, David was the Executive Secretary of the Financial Action Task Force and the Senior Advisor to G7 and G20 on AML and counter-terrorist financing from 2015 to January 2022. Previously, he was the head of AML CFT policy for HM Treasury. Hi, David. Next is Maria Evstrapova. Maria is a director in our Financial Services Compliance and Regulation practice. Maria has over 16 years of experience in the financial services industry, specializing in anti-money laundering and sanctions compliance. Welcome, Maria. And then we have Hayden Jones. Hayden is a Managing Director and the Global Head of Blockchain and Cryptocurrency Solutions for Kroll. Hayden leverages more than 25 years of experience across multiple sectors leading sales and execution, and is now exclusively focused on cryptocurrencies and blockchain. Prior to Kroll, Hayden was the founder and Managing Director of Blockchain Hub, a blockchain and digital currencies advisory company. Hayden has also held positions at the Bank of England, Deutsche Bank, and the UK Ministry of Defence. Hello, Hayden. Today's session will be broken up into three key themes: financial crime and technology, beneficial ownership registries, and crypto and data. And that'll be followed by about 10 to 15 minutes of live Q&A. So to start off, it's clear that the Fraud and Financial Crimes Report is not only timely, but that we are at a crucial point in getting ahead of financial crimes globally. In fact, one of the most startling statistics from the report is that 2/3 of our respondents, consisting of C-suite and risk professionals, note that they expect financial crime to increase in the next 12 months. I found that particularly fascinating and, to be honest, somewhat startling. David, could you walk us through what you are seeing, given your background in AML?
Thanks, Mary-Ellen. I'd be delighted to. In short, and the context for this report is that money laundering and financial crime is a growing problem. So if we step back 30 years to the start of efforts in this area, Time magazine ran with a front cover page, the billion-dollar shell game, money laundering, the billion-dollar shell game. If they were to run the cover again today, it would be money laundering, the trillion-dollar shell game. So the problem is growing, and the number of ways in which money can be laundered is also growing. And we'll hear later from Hayden about cryptocurrencies. Today, I'm going to talk about some of the key findings and provide my reflections on those in the context of the financial crime problems we're facing today. In terms of the size of the issue we're facing, well, it's anyone's guess, but there are estimates between $800 billion a year rather, and $6 trillion. So 800 billion and 6 trillion laundered every year. The cost of that for financial institutions alone is up to 1 trillion a year. And what is that generating? Well, we're looking at some 34 million suspicious transaction reports, and all of that effort produces some $20 billion worth of recovered assets, which is less than 1% of the total amount of money laundered every year. So it's a huge issue, a growing issue. It's becoming more complex, and we're not doing very well. But as we'll talk about today, the potential for doing much better, particularly with the use of technology, is right with us, right around the corner, and the opportunities are huge. So, Marilyn, with that, I know we have a polling question. Back to you.
Thank you very much. Audience members, you should see on your screen our first polling question, which I will read out. Which one of the following factors are most responsible for increased financial crime risk? A, cybersecurity and data breaches. B, financial pressure on companies or individuals. C, impact of remote working or decentralized management. Or D, increased regulatory enforcement. Please select your answers from the 4 options on your screen, and we encourage all of you to participate so we can reflect on the responses from our group today. Okay, we have some responses coming in. All right. Great. Please go ahead and finalize your choice. All right. Excellent. Okay. Thank you very much. And Raksha, can we have the results, please? So it looks like our participants selected A, cybersecurity and data breaches. David, what are your views on the audience result today?
Well, actually, that's very encouraging and interesting, because the audience has responded in exactly the same way that the respondents to our survey did and is represented in the report. So in fact, cybersecurity and data breaches were the #1 reason for increased financial crime risk. Over a third of our respondents selected that as well. So this is in the context that most people, more than 2/3 of our respondents to the survey, see financial crime risks increasing. And in addition to that, most people, again, similar number, expect to invest more in technology in the future. So this is both good and bad. And here's the thing. From the global standard setter, the Financial Action Task Force, down to national regulators, and even our work at Kroll, the thing that undermines the effectiveness of all financial crime and AML measures is a good understanding of risk. The bigger banks are getting better at this, but they are by no means perfect, and they often confuse legal, regulatory, and reputational risk with assessing the risk of being used and abused for financial crime. They see the risk as the risk of being fined by a regulator, not the risk of being used by criminals. And smaller banks, newly regulated players such as fintechs and crypto firms, and the non-financial sectors such as lawyers, accountants, casinos, real estate agents, and trust and company service providers are actually very poor at understanding their risk exposure. As a result, their response and defenses are poor and at best inadequate. So most people don't actually have a good understanding of their financial crime risk, whether you're talking at national level with governments, whether you're talking about regulators and their ability to implement risk-based supervision, or whether you're talking about most firms. There is generally not a great understanding, or certainly not a nuanced, sophisticated understanding of financial crime risk. And there are now more complex risks added by systems of controls that we know are lacking, and a rush to acquire technology to solve the problem. And these technologies may create huge opportunities, but they also represent vulnerabilities. As firms look to tighten their belts, seek efficiencies, and some seek greater effectiveness, they are increasingly turning to technology. But there are lots of tech solutions out there. They offer huge potential, but it's difficult to know what they offer is what they say they offer. It is often more difficult to know how they work and to be able to explain this to regulators when they come calling. Regulators are increasingly supportive of the use of technology, but they will come down hard on firms that farm out their liabilities to tech and don't understand it, or that technology is unproven in being more effective at detecting and preventing financial crime in their organizations. So it's really important that firms consider tech solutions carefully and seek good advice. They need to understand what problem they're trying to solve in the first place. And each firm will be in a different position with different legacy systems and different risk exposures. And they need to try and ring fence different scenarios and exercises in which they can try out technology. If firms see financial crime risks increasing, but they don't invest in properly understanding these risks, and they rush to replace people with tech that they don't understand, this is a recipe for a perfect storm and exposing the business to much greater risks. There are, though, examples to learn from, but there is a different solution for everyone. I'm particularly excited by dynamic risk assessment models and the recent experience of HSBC and Google, where they have replaced transaction monitoring with closer to real-time DRA, dynamic risk assessment, combining both supervised and unsupervised learning techniques that they have shown to be more effective in detecting and preventing crime. There is huge potential for such approaches, and they are not limited to tackling financial crime. Ultimately, they could reduce the systems needed and improve the effectiveness across fraud, anti-money laundering, anti-bribery and corruption, cyber, and even tax compliance. There are also promising new risk-based pricing solutions and financial crime indexes where you can benchmark your risks against the market and price transactions accordingly, rather like a Moody's, but for financial crime. We also see a surge in public-private partnerships. And these are great, but again, no one size fits all. We know banks need to be sharing information amongst themselves as well as with competent authorities, but how to do that without breaching data protection and privacy rules? Privacy-enhancing technologies offer great potential to do this, but they need to be scalable, and they are only part of the solution. In conclusion, financial crime risks are increasing, and most people are seeing that, but do they truly understand how they're affected by it? And technology offers huge potential, but also presents risks. And a rush to replace people with tech is not likely to be the answer. Tech should be explainable and should free up the expertise of your people to do what they do best and not just process false positives. Ariana, back to you.
Well, David, with that, you mentioned vulnerabilities. And you mentioned that we are exposed to risk, but yet we don't necessarily understand that risk. So my question to you is, how does one understand their risk? How does one understand the vulnerabilities? And how do you navigate that storm that is coming?
Well, as I spoke to, one of the things we need to get to a grip is a better understanding of financial crime risk and what technologies to implement in determining that, including understanding who's behind customers, who's owning and controlling corporate customers, in particular because we know companies and trusts are abused by criminals, not just for money laundering and terrorist financing, but also these days for sanctions evasion. So it starts with doing a proper risk assessment, and not once every 1 or 2 years. And the risk assessment must be supported by quantitative as well as qualitative evidence and be focused on the risks of being used for financial crime, not the risks of being fined by the regulator. Risk assessments need to become closer to real time, such as dynamic risk assessments, as I spoke about, rather than a periodic exercise or something to show the regulator when they turn up. So you need to understand who your customers are, not just monitor transactions. You need to monitor customer behavior. Financial crime is ultimately about people, not just transactions. It is more important than ever that you understand your customers and who is behind them. And there are more ways than ever before to do this, but you can't turn it into a tick box approach by just checking a register, for example. You need to use multiple sources and to triangulate between them.
Well, thank you for that, David. And thank you also for queuing up the next part of our discussion, which is beneficial ownership. And for this, I would like to turn to Maria. Maria, could you discuss what firms can do to prevent financial crimes from furthering and what practices they can adopt to better understand their risks?
Thank you, Marilyn. It is so true that financial crime comes in all shapes and forms, and the connecting common element that makes these crimes go undetected, in my view, is the use of opaque corporate structures set up by professional enablers. The numbers David mentioned earlier are just astonishing. Despite numerous scandals like Panama Papers, Paradise Papers, Pandora Papers, we continue to see shell companies being used to hide true identities of those behind them. And I think adding to that poor control infrastructure and also lack of beneficial ownership, transparency, still in so many jurisdictions, is a perfect solution that allows criminals to continue abusing the system. Paired with that also, as David mentioned, lack of understanding sometimes of the risks that the businesses are exposed to from the financial crime perspective also adds to this. Corporate transparency is a topic that continues to being discussed and remains one common issue that connects money laundering, breach of sanctions, and tax evasion. Most, I think, would agree with me, at least, that knowing whom you are in business with is absolutely crucial. One might ask, why is corporate transparency so important? Recent Europol report that I read, it's called The Other Side of the Coin. I highly recommend as a bedtime reading, if you're interested in financial crime, that report analyzes financial and economic crime and talks in general about how corporates are being used to mix funds easily across different jurisdictions and often offshore ones, ultimately belonging to the same individual or group of individuals. Pandora Papers revealed international network of companies used to hide ownership of money and assets at the global scale. The impact on the firms that have been implicated in these papers have been substantial. Reputational damage, regulatory intervention, ultimately it has an impact on the profitability because clients may not want to associate themselves with these firms. David mentioned also sanctions evasions. In the current environment, it is done through third parties purchasing goods and then through a series of companies transferring these goods to the end user that might be subject to sanctions. Some of some of the audience may be aware that there have been a number of prosecutions in the US recently, and the UK government also promised to bring those that try to evade sanctions to justice. But lack of accessible and, most importantly, reliable beneficial ownership information in this day and age is really unfortunate. Establishing a central registry, in our view, is an important tool. And it's the tool that will help fight against the things like breach of sanctions, like tax evasion. And I'm happy to say that respondents to our survey also agreed with us. 87% of the respondents globally said that having such registry would be beneficial. Although when we speak to our clients, they often say, this is a great onboarding tool. We would use that for the verification purposes. And again, referring back to what David mentioned before, I always have to be the bearer of the bad news for some of our clients because it is just a source of information and at times not very reliable one. And it definitely cannot be used on its own. Often than not, in complex cases, additional documentation is required to corroborate the information. So if you were to take away one message from me today, please use the beneficial ownership registries as a source, but not wholeheartedly rely on it. In the UK, we have a registry accessible to public, but the quality of the information is highly questionable. Going forward, at least here, the Companies House will be required to verify the information being submitted to the registry. And also we have some changes in the discrepancy reporting rules. So hopefully all of that will help to clean up information so that the registries generally can become more reliable. And since 2016, and I know that a number of other countries have established these registries, and from 2018, Fifth Money Laundering Directive obliged all EU member states to establish them. of course, then it was challenged in court. And in November 22 last year, ECJ ruled that public access to information on the beneficial ownership constitutes a serious interference to the fundamental rights to private life. So as we know, as a result of these rules, a number of countries have suspended access, but then some restored it back, introduced additional rules on who can access it. So when we speak to compliance professionals and to the businesses, all say that I think they see the introduction of the beneficial ownership registry in some shape or form as a positive thing. It would be very helpful during the due diligence, and all say that it will be helpful in the internal investigations. It will help the internal FIUs during transaction monitoring. And I couldn't agree more. Having access to a central beneficial ownership registry with accurate, up-to-date information where corporates, where the entities declare which individuals control them, would be instrumental in the fight. There are just so many moving parts at the moment, and we just don't know what these registries would look like and who would be able to access them. So how helpful they might be in the end. But I'm interested to see what the audience thinks. So I think I will pass it over to you, Marilyn, for a poll question. I think we have one on this point.
Absolutely. So we know that having access to beneficial owner registries with accurate information is instrumental in the fight against financial crime. Let's turn to our next polling question to hear our audience thoughts on this. And here we see the next question. We're seeing the adoption of registers around the world. What are the common issues seen with this? A, access, B, costs, or C, quality of information? Audience, if you could please submit your answers.
I'm really interested to see what the answers will be.
We have some responses coming in. All right, audience, please continue to submit your responses. All right, we have a fair amount in already. Let's see here. All right, let's keep a couple of last stragglers if anybody else wants to submit their response.
I think we have most of the respondents.
Okay. Raksha, can we get the results, please? All right, it seems that the audience has selected C, quality of information. Maria, I think you touched a bit on this on your talk before. What are your thoughts on this?
Definitely. Well, I couldn't agree more with this result, to be honest with you. Obviously, I'm based in the UK, and here we have the open register for public, but it is not very reliable because in my experience working with a variety of clients, we've seen Jesus Christ and Mickey Mouse registered as directors in UBOs of companies. And we've also seen a number of times that the name of individuals are just slightly changed to be seen as a different individual, but in fact, it is the same individual registered in multiple corporates in different countries. So I would say the quality of the information is definitely an issue. I would also probably agree with the access to information answer with the audience. I think one thing we hopefully can agree on as having access to some information is better than not, but how helpful it will be is another matter. And obviously the content and the accessibility is yet to be determined in a number of countries. I think from our understanding, we expect most registries, if made public or when they're established, even if they're accessible just to authorities, they would have information on the name, the date of birth, the address. It's hard to say definitively what may be the case, as there's just not that many open registries around the world. And I would say any information is better than nothing. But I want to emphasize and just build on the point that David was making earlier, the importance of due diligence. Only last week, a federal judge in the UK, in the US, convicted a US national. He was conspiring to violate US Iran sanctions by participating in the scheme of unlawful exportation of some heavy equipment from the US, and they were using a Florida-based business, and the shipments and the payments, they were routed to Iran by UAE. In this example, knowing whom you are dealing with is of course very important, but would still not replace the due diligence that firms need to undertake on the business and the roots of the transactions, the reason for orders. So I think often firms don't have the right information on files to conduct the enhanced monitoring, to conduct this enhanced screening and review, because the data quality is rather poor or the technology is not quite right. So many financial services firms are still remediating and cleansing their data to ensure that when they're doing the transaction, the screening can be adequate, and they can identify the right individuals and analyze the transactions accurately. I'm sure we all have heard about the concept of rubbish in, rubbish out. It is so true. So I suppose I will end with one message. Corporate transparency is very important for the industry to help gatekeepers, financial services firms, corporates. We need to help to detect and prevent financial crime. But the beneficial ownership registries alone would not achieve that. We need corroborative approach combining multiple different sources. We need accurate data, good and most importantly, right technology solutions tailored to the business. We need the high caliber of people with the right training, conducting due diligence, reviewing transactions, conducting screening, advising clients even on what is right and what is wrong. So I think only then we globally, the industries collectively could do a better job fighting financial crime that has devastating impact on societies, and the amount of funds that are being laundered globally, it's just astonishing.
Well, Maria, I could not agree with you more, especially on the due diligence part. I think it's absolutely an essential part. So thank you for that. It was incredibly informative. Well, as we all know, in this day and age, we cannot have any discussion on financial crime and fraud without discussing cryptocurrencies. Before we jump into that, we would like to find out what our audience knows about this digital currency. So we will be moving to our next polling question. Excluding NFTs at this moment, how many cryptocurrencies do you think exist? A, under 5,000, B, between 5,000 and 20,000, C, between 20,000 and 40,000, and D, over 40,000. Audience, please submit your answers. This will be an interesting one.
I'm sat on the edge of my seat here in London, waiting for the response.
Am I, Hayden? You don't know? Go ahead and take a guess.
And you're not allowed to use Google.
Good point, Hayden. Thank you for bringing that up. we'll give it another couple seconds here. Okay. Move. All right. So Hayden, as mentioned, we're going to find this very interesting. You and I both know what the answer is, and it seems that the audience has selected B, between 5,000 and 20,000. What do you think about that?
Fascinating, absolutely fascinating. This is one of my favourite go-to questions when I speak at conferences and do facilitated workshops. And it's quite interesting that because it's, I would say that's it's a fairly broad distribution actually. It looks bell-shaped, if I'm honest. It's approximately 27,000, and we excluded NFTs because there's about if you add back in NFTs, we get to a number of about 1.8 million or thereabouts. So it's just slightly easier to exclude NFTs for the moment. The reason is that we're dealing with software. Okay, Bitcoin as a protocol is open source. Obviously, Bitcoin is the first cryptocurrency that's out there, and it's very easy for people to download the code associated with Bitcoin. And what that's led to over the last 14 or so years since Bitcoin was launched is a proliferation of coins, with people at one level thinking they can make a quick buck, or at another level thinking that they can create something that will change society. And for those of you not close to cryptocurrencies, what we're dealing with is effectively a ledger. So I'm sure many of us are financial professionals on the call, so we understand the concept of a general ledger. And the best way to think about crypto is looking at your general ledgers, and where you see a ledger, an entry in the ledger, it's a number that references a balance in a bank account. Well, in the case of a distributed ledger, which is what blockchain and the cryptocurrencies are based on, what you're actually looking at is a store of value. So you have a ledger, a shareable ledger with a store of value on it, and we can actually transfer payments from addresses to addresses. And the interesting thing, as I said just at the outset there, is that because it's written in code, we can attach conditions to it. So we have a store of value sat on a shared ledger that we can move around. We can move the values around, so that affects a payments platform. And as I said, because it's written in code, code loves if-then statements, so we can attach conditions to the way those values are actually transferred from individuals to individuals. So it's a very, very, very powerful technology, but very difficult to regulate. And as we step through the slides, I think you'll understand as well, some of the challenges from a financial crime perspective.
Well, Hayden, the report expands in quite some depth the ways that we can use technology, especially in the crypto space, to fight against financial crime. Can I ask you to please discuss that further?
So what was encouraging was, that first bullet point up there. It says 22% said it wasn't really a concern at this time. And that for me implies that at least 80% of the world are really beginning to understand this. I think David had made the point earlier in the session with regards to digital currencies representing one of the major issues in terms of understanding. Well, I think the results for me show there's good traction there in terms of understanding the challenges that we have here. But that still means there's 22% out there that say, and that's either because of sectorial bias or because it's not really registered. So there's still some further work to be done there. We're dealing with technology. The heading of the slide says, "Can technology stop crypto crime?" The beauty of this technology, and I was having a conversation yesterday with a very large global bank explaining that the beauty of this technology is that it allows us to look at the history of the of the transaction itself. So I can look at a Bitcoin address. I can look at the hygiene associated with that Bitcoin address. So I can see where it has been, where those, the history of that Bitcoin transaction. I can see where there are adjacencies to public addresses that can be attributed to some kind of criminal activity. So we can scan these addresses. There are scanning tools out there that we work very closely with that allow us to look at a transaction holistically. and play back what's happened in the past. And actually, going forward, I think David mentioned that, dynamic risk assessments. We can then poll, we can monitor public addresses on an ongoing basis. So you have the now, but then you have the future, and we can monitor the risk profile, the hygiene associated with these public addresses, and how that changes over time dynamically. I think the challenge we then have is, that third bullet point there raises the point where we actually have three worlds that we have to bridge, because you have traditional finance, you have crypto, and you have financial crime. They all have their own unique challenges in terms of technology, culture, process, people. So, we're in the challenging position is that, in our crypto team, we actually have to think about three worlds when we go into a particular matter. We have to work out how we bring those three worlds together and then present a story for the client in relation to how we address that particular matter. It starts with what is the crypto. Crypto is a very broad term. I think you've already seen that, with 27,000 or so digital assets out there, you can't be a specialist in every single one. You have a good understanding of the basic principles, but largely, broadly speaking, every opportunity, every matter that we deal with, it cuts into some new cryptocurrency that we've not encountered, that's recently been issued, and we have to sort of take it apart. We have to understand where it sits in relation to the transaction that's been undertaken. Entities is very important. So you sort of segment that term crypto in relation to the types of digital assets. So you'll have things like Bitcoin, which you, broadly speaking, you can construe as a store of value. You'll have stable coins, you'll have securities, you'll have utility tokens. So those are your crypto, if you like, the digital assets. But from an entity perspective, you have exchanges, custodians, wallet providers, and issuers. So you have two axes there, types of crypto, types of entity. And then there are subsidiary entities as well, because we often have to deal with crypto miners. So you have Bitcoin miners, and they pose a threat from a money laundering perspective. But you also have ATM operators as well. And they also pose a very potent threat if they haven't erected the right sort of AML perimeter around their operational activities. End-to-end regulatory status, I always look for line of sight between individual, the fiat, the cash that they have used in relation to the transaction, and where they currently are now. Okay, and what I look for is a very clear regulatory channel. Okay, so I want to see boundaries either side of that. And what I want to see are entities and protocols, which may in some cases are regulated. But what I want to see is line of sight between the individual, the assets they've got now, the assets that they had previously, and a nice channel all the way through that I can see lots of grown-up regulatory licenses that have been granted to the different entities that they use, so I can feel comfortable in relation to the hygiene associated with that individual and the transactions. A holistic view of the transaction is essential, and that's what we seek to provide in the work that we do with our clients. Right at the bottom there, there's further opportunity. One third indicate financial crime compliance programs cater to an organization's cryptocurrency risk. There's another 2/3 out there that warrant, further support and challenge in terms of the way that we can assist them. So we've got a encouraging number right at the top there, with 20% said it wasn't really a concern at this time. So that means 80% of the world have got their heads around this. But right at the bottom, there's still further opportunity in terms of actually assisting those compliance programs to get people up the curve and get them understanding, applying this technology in a way that we can understand what those crypto risks are. I think, Mari Allen, you may be on mute, my fellow colleague.
Thank you for that very much.
That's all right. That's a pleasure.
I was thanking you for touching on the technology component. I know that was a big part of our report. And I know in our study, we also did a deep dive into data and its role in crypto. So as one of our data experts in Kroll, could you please expand on the relationship between data and cryptocurrencies?
Well, there's that top bullet point there. It's 20 years ago this year that I worked for somebody, and this was his mantra. Okay, and he would stand up in front of us and he would say, "In God we trust, everyone else being data." And I must confess at the time, I thought it was brilliant, but I thought it was his own mantra. And I did a little bit of digging as part of the report and discovered that it's actually it's derived from a gentleman called W.E. Deming, and his focus was process improvement, and that was his mantra. So this was Deming's mantra. And it's something which has stayed with me. I'm an engineer, so I'm an electrical engineer, so very data-driven in terms of everything that my career has been built on. But for me, this is the mantra that we apply in relation to how we use technology to stop crypto crime. Okay, you can see there almost 50% cite data integrity challenges when you're working to implement technology solutions to support core client lifecycle processes. I mean, I've come out of investment banks. I've seen the challenge of, and I describe it as the growth of the imperfect organization. You look at the way these large global organizations are bolted together, they're sort of veneered together with layers of different legal entities. In the classic M&A type transaction, there's always a rush towards the end, and then they'll say, well, actually, we've got company A's systems over there, just leave them exactly as is. And then before you know it, you've gone through sort of 2 or 3 economic cycles of growth and downturn. You've plugged together, 10 organizations, and you end up with 15,000 systems, all of which struggle to talk to each other. So it is a massive challenge, and it's within those systems that all of this latent data sits, which is the primary indicator of what risk we can associate to particular customer events. I'm a big believer in cloud, and that's something I'm sure that everybody is familiar with. But poorly organized data ported from a legacy environment into the cloud is not the answer. It's absolutely essential, and it's difficult. I mean, I've led data-related projects. It is very difficult to encourage the business to own their data and go through the painful process of globally having a single customer identifier. It's always too easy to sort of say, well, actually just leave it like that. It's absolutely fine. We've got 15 customer identifiers for the same customer outfit. But I think it goes to one of Maria's points, actually, and one of the questions that was raised. There should be standardization at a legal entity level that flows through into your CRM system, and then across into your payment system, and then it's from that you use you drive your risk systems so that you've got a single source of truth in relation to what your customer legal entity identifiers are, and that solves multiple problems. We make the point, I've made the point there, consistency of records across multiple systems. I've seen this far too many times where you poll one system with one query, you poll another system with another query, and they're out of date. There's a wonderful, wonderful line in there, and I learned this when I started at Swiss Bank Corporation. Data should be stored once and once only, okay? As soon as you start moving data around the organization or replicating it, you create problems because you end up with, well, that hasn't been updated and we're waiting for that batch system to update, and that only happens every month. And you get into all sorts of challenges then in terms of the integrity and the hygiene associated with the data. 2 bullet points at the bottom, and I love these. I've seen far too many, because ultimately this boils down to a technology strategy, and I've seen far too many technology strategies that run to sort of 200 pages of PowerPoints and such like. But your technology strategies, which ultimately drive your data frameworks, they have to be simple for people to understand. And this was one of the mantras that I acquired in one of my roles: run the bank, change the bank. So we need to break, segregate the systems, what's running the place and what's changing the place. At the most simplistic level, I have to have a set of metrics that measure how good run is, so how clean are the data. And then I want to see if I'm investing in change, what's the return on that? So am I seeing an improvement in terms of the data hygiene? Measure your data hygiene, okay? Measure your data hygiene, associated with those identifiers across systems. And then all of your systems have to have a flag, which is retire, maintain, invest, govern. So that you need to know whether you're going to keep a system, whether you're going to get rid of it. You need to know whether you've not decided, which is maintain, and you need to decide whether you're going to invest in a system or not, and then have a governance framework that sits around that so that you can actually make the right decisions at the right time based on the right data. And this is all about, effectively about a technology strategy, but that ultimately drives your data strategy. And then final one at the bottom there, and this is something that I would strongly advocate for everybody to take away and discuss with your respective business leaders and HR departments. Reward success as it relates to data hygiene and stewardship. Promote it around the organization. Create these data stewards. Explore the opportunity of having a chief data officer, and they will then have responsibility both for leveraging the data from a revenue perspective, but also from a financial crime perspective. So hopefully that's helpful. I believe we go back to Mary-Ellen now.
Well, thank you for that, Hayden, and I found it very helpful. I think our audience probably today also found it helpful. I also wanted to thank our speakers today for setting the stage around fraud and financial crime, as well as highlighting what challenges and opportunities to expect in the future. With that, I would like to open up our Q&A session. Please submit your questions for our panel. And I see that several have already come in. Please feel free to submit some more. And it looks as though the first question here is for the group. Could you elaborate on the DRA concept? How can it be implemented on a real-time basis? David, can I throw this over to you to start it off, please?
Thanks, Mario. Yes, I mean, it's still a relatively new concept, and there are no current off-the-shelf solutions. So it's not something you can currently go out and buy. And it's not currently real time. The aim is to get as close to real time as possible, and to move away from the kind of periodic transaction monitoring that characterizes much of what industry are currently doing. I mean, first of all, you do need a good technology partner. HSBC were obviously very lucky with Google. I think that Google are looking to commercialize that at some point, but I don't know when. And I know that HSBC are confident, they've said publicly they're confident enough to be able to stop their transaction monitoring in the UK and to replace it with DRA. And they're now looking to do that in other countries, particularly those that are have a enabling environment, a good supervisor. So Mexico, Singapore, Hong Kong maybe. So having a good technology partner is critical. Then there's a question about data, and we just heard from Hayden about the importance of having good data and not updating legacy data problems into the cloud in order to do this. There's a real risk that if you rush to DRA, you might just be optimizing stupid. You're using, if stuff doesn't work well already, then it's not going to work well in an automated machine learning environment. You need good financial crime expertise. So this isn't a replacement for financial crime expertise. What it does is it frees up your financial crime experts to do what they're good at doing. And it also means that you can use those guys to put together topologies that you use to run against the data that you've got. So you're looking for customer behavior that meets a certain set of topologies that you know are concerning, and that's what we call supervised learning. And then there's unsupervised learning, the other part of this, which is what is the behavior that looks unusual, that looks strange, and what are the outliers in terms of what's normal. So as I said, this is not something you can buy currently off the shelf. It does need to be developed and suited to your current needs. And a lot of companies out there will try and sell you a Formula One racing car, whereas all you might need is a go-kart. And don't rush out to buy a racing car if you don't know how to drive it. A lot of this is not just about buying the right tech solution, but knowing how to tune it for your individual needs. So you do really need to understand what problem you're trying to solve, what the state of your data and your current systems are. You need to have a reliable technology partner, and you need to have some good advice to take you through this. So it's not easy. You need to work closely with regulators as well. You don't need their permission to do it, but you do need to keep them well informed. You need to be confident that before you switch off legacy systems, that this is going to be more effective in detecting and preventing financial crime. But I think this is the way forward. And we're very happy to work with clients who want to explore it.
Thank you, David. Hayden, anything you'd like to add to that?
Just very quickly, there's Andy Haldane, former chief economist of the Bank of England. He talks about in one of his speeches, it was probably about 7 or 8 years ago now, I think, but he talks about this Star Trek-like vision for regulation, and the idea that he could look at a dashboard that gives him the heat footprint, if you like, of the different regulated entities, and it's exactly the same concept as dynamic risk assessment, because you're sucking data up, you're processing it, and then you're coming up with metrics that change dynamically, so real time, on a second-by-second basis. And for me, with cryptocurrencies, we can poll asset addresses, we can poll entities, we can poll the individuals that hold those assets. We can poll them 24/7, 365 days a year, and create a dynamic report that tells you, red, amber, or green, what the risk profile looks like. And as David said, I mean, this is still emerging from it conceptually, but certainly, I've had a number of conversations about building a dashboard for entities, whether it's a bank or whether it's a regulator, to actually dynamically profile the digital asset risks that they're seeing, because this is digital technology. The clue is in the name. It's all about code, and we can poll these these public addresses, as I said, dynamically.
Excellent, thank you. Hayden, it looks like the next question is also for you. Hello, Hayden. Given the proliferation of crypto assets globally, do you think there should be a super crypto regulator, distinct from competent authorities by jurisdiction?
I think there's a number of ways to answer that. It's an excellent question there from Peter Newton, but there's a number of different ways to answer that. I think the practicalities of creating a super crypto regulator, and that's the easy way to answer it, I think, are immense, because it implies geopolitical alignment. And I mean, we've only got to open the newspapers today to understand and just sort of review where we the different divisions that exist, traditional divisions that exist geopolitically. So I think it's a real challenge to do that. Notwithstanding, there are, and it's a very interesting point of reference this, but there are very few global regulators, one of which is the International Telecommunications Union, which was formed back in the 1920s. So Marconi, a wonderful gentleman who created radio. The nations of the world realized that radio was incredibly powerful, but they also realized that they had to come together and actually standardize the different opportunities that they had to sort of implement this technology. So the ITU is, it's in its 120th or so year, or thereabouts, is one of the few global regulators that are out there. I think BIS play a very similar role. I think that BIS do provide standard settings in relation to digital assets, which I think is very, very helpful. So I think, for what it's worth, I think G7, G20 countries will come together and they'll form a view in terms, and we're getting there slowly with requests for standards and such. So I think some level of global standardization will happen inevitably, but I don't think it's possible to create a super crypto regulator.
But we shouldn't forget, Hayden, that we have the Financial Action Task Force who have set global standards for virtual asset service providers, and where countries have committed to implement those standards. So even though the FATF is not a global regulator, we do have a set of global standards that regulators are expected to get on and implement. And so I think what we can hope for is greater consistency in regulation amongst countries, because the lack of implementation of those standards by many countries at the moment provides huge opportunities for criminals and regulatory arbitrage and just creates problems. So I think the combination of good national regulation and a set of global standards that everyone's working to will help deal with the problem.
I think the key there is that standardization, right? That makes a lot of sense. The next question is for Maria or David. Both of you can chime in here. The EU's court's decision is a blow to the establishment of individual European members' countries' BO registry and an EU-wide BO registry. But it also inspired others and other countries to oppose the creation of BO registries elsewhere. Do you see an eventual possible challenge to the EU court's decision?
So maybe I'll kick off, Maria, and then if you want to jump in, please do. I think the ECJ ruling was disappointing and probably a bit of a win for the crooks out there. However, on closer sight, if you actually read it in detail, what they weren't saying is that this information can't be available. What they were saying was there needs to be a proper mechanism to manage access, and in particular, legitimate access to this information. And so where I see this ending up is the information being available to competent authorities, also being available to what the EU call obliged entities. Those are regulated businesses, so banks, lawyers, accountants, and others. I think that's a given. The extent to which it's available beyond that to those with a so-called legitimate access, there needs to be a proper mechanism put in place to decide that, and that will also address some of the safety and privacy concerns that people have with this, because it is possible to develop registers and access to registers that protect people's privacy, reasonable requests to have their information held back from public access. So I think we will end up in a good place. But I think this judgment will just make us think harder about how we do that, and it will take a bit longer to get there. And in the meantime, it's led to some EU member states pulling access to their registries. We saw France initially pull access to its registry and then reopen it. And I think it's led others around the world, not just in the EU, to question whether they should rush to public or start off with, a managed access to obliged entities and some others, investigative journalists and so on, rather than going straight to public. So I think we'll get there, but it means that it won't just be, they're not all going to be public tomorrow. And I think that's probably a good thing.
Maria, anything to add?
Yeah, I completely agree with David. I think it is important to remember, why do we need to have a beneficial ownership registry? I think creation of one would help reduce the risk of various financial crimes, help law enforcement authorities and internal FIUs within the organizations, within financial services sector that is seen as a gatekeeper. And it needs to help these type of organizations to do their job. So having a public access where everybody can access, I can see why people will be concerned about their privacy. But certainly for law enforcement and the financial services sector to have access to that information, I think is quite crucial in the fight, I think, as I mentioned before, because often than not, you can reach a dead end when you're trying to investigate and you're looking and trying to understand who owns the company. And I think we at Kroll, through our own work, we know also better than anyone when we're trying to put together or review a transaction and investigate the flow of funds, having access to information paired with online research is a very powerful tool.
Agreed, 100%. And I think we have time for one more question. And Hayden, I'd like to throw this over to you. Is the sandbox approach the best one to regulate crypto exchanges in relationship to the risks of AML?
So we'll close immediately after this, I believe, Mary-Ellen, but very, very quickly, the process of regulation is about risk assessing, it's about intervening, it's about recovery when things go wrong. If we look at mature regulatory models that are out there, and I'm thinking about the banks, the insurers, they don't have sandboxes, okay? They're in a very mature place as it relates to regulating what are large, supervising very large, complex financial institutions. as the name suggests, a sandbox is somewhere to play. And sandboxes have been very, very helpful, and they allow the regulator to learn about what's happening in a crypto firm. So they have a role, but I don't necessarily think they have a role in a mature regulatory environment. But UK was one of the pioneers, so it's great to see us being able to have sort of contributed something as far as that piece of thinking is concerned. So back to you, Mary-Ellen.
Well, looks like we are at time, actually. So I would like to conclude by thanking our audience for participating in this discussion. It was, I think, quite exciting. And we encourage you to catch up on more findings from this year's report and learn more about our speakers, both of which you can do directly on your screen. We hope that you enjoyed our webinar and have a great rest of your week. Thank you very much.
Bye, everyone.